Well, hello, everybody. We're going to do something a little different today. I actually don't know why I'm smiling. Um, I think a lot of times in this business, we make predictions, we make guesses, we go about doing things, and sometimes we get some new information and we have a different and a fresh perspective. And I want to say there is something I've been talking about for a while, and I have been, I think, 100% wrong about it. So let's go ahead, let's get started. Allow me to explain. Let's go. My name is Stephen Meade with Domicile Real Estate, where we are on a mission to help California's renters become homeowners. This is our Southern California housing market update for February 25th, 2025. And I was wrong. So, one of the things that I frequently talked about on here is this notion of looking at certain milestones and attempting to predict how the year is going to go based on it. So I've often said something like how our spring is going to go. We're looking to see how the summer is going to go based on some early results. And I think before the pandemic, this was a pretty normal thing. We had a certain cadence to our housing market. And I think at this point, it is foolish to believe that we're really following that kind of cadence very closely. And I've got some really, I think, important data to back that up. So before we begin and jump into that, let me just kind of lay a little bit of the groundwork here. Like most other housing markets in the United States, we had a somewhat cyclical nature to that and a certain sort of pattern of behavior, right? We would start off the year, not a lot of listings. We go into the spring. Sometimes how soon that hit would vary. Prices would take a jump. We get a lot of our pricing gains would actually happen in that portion of spring, before school even got out. That's when we really start to see a big portion of our pricing gains for the year. We kind of coast through summer and then we ease off into the fall. And I think with so much almost economic uncertainty and the ground shifting between our feet, I think that is simply no longer true. I don't think we're seeing nearly that much of a pattern. And I've really got some data to back that up and to explain why, if you're a home buyer, especially if you're a home seller and you're thinking that there's going to be some predictability to the time period of year that you either jump in as a buyer, you jump in as a seller, unfortunately, I've got some good news and some bad news for you. The bad news is, I don't think that's true anymore. I don't think there's some easy formula to follow that says if you want the best deals, buy in December. Likewise, there's a good side to this, right? And that is if you're the kind of person who really pays attention to where the market is, I think you've really got an opportunity to make better decisions and be in a better market if you're willing to pay attention to what's going on, because it really is not predictable in following that cadence. So let's go ahead and we are going to jump in to those statistics because I think that really helps illustrate the point. So first thing is some good news for buyers, right? We've actually got more inventory out there. So whether that means you think the market's a little less competitive or whether you just like to have more choice, in both under a million and 1 to 2 million, you've got more choices out there. That's a simple fact. I mean, we're probably up 50% under a million and up a bit. Even almost up by that same amount, maybe even a little bit more on our 1 to 2 million. Now, if you look at our new listings hitting the market, we are kind of at a point now where we're maybe a little bit where we would normally be in that April timeframe, or maybe even a little bit less than that under 1 million market. But we're also seeing more new listings hitting the market, right? I think this is a good thing. If you're a consumer, you like choice, I would say now feels like a good time. And then if we look at our new escrows, we see that 1 to 2 million category. I mean, new escrows are definitely above where we were at last year. We are right at about the same point as we were at last year for under a million. So what's the message here? If you're looking under $1 million, this is a better year than last year. And if you're looking 1 to 2 million, it's probably about the same as we were at last year, maybe even still a little bit better. Now, if you look at our absorption rates, right, I mean, that tells like another story here. You're going to see these absorption rates are lower than we were at pretty much for almost all of last year for under a million, and we're lower than a good portion of last year for 1 to 2 million. So I would say right now at this moment in time, you're in a pretty good spot if you're a buyer. Now, if you're a seller looking at this stuff, guess what? You really need to make sure your property is well prepared, well marketed, all of those things. By the way, quick plug. If you don't think your agent or you don't know someone who fulfills and acts that way, we can definitely help you there. So if we move on to our closed prices, though, this is the part that really sets a different tone, I think, for this year. I mean, look at these graphs. Remember, we're looking in the rearview mirror. I don't ever remember a period of time where the deals that were done in January were the ones where we saw huge price increases. But if you look at these charts, I mean, really, this should tell you something, right? I mean, look at how much ground we gained between the low point at the end of the year. And this is across all three price categories, right? I don't think I ever remember a year where things really started that early. And I don't think it's just the fire stuff. I don't think it's just that. I think this is a year where our gains have occurred largely in the beginning. And I'm wondering, and I'll explain a little bit more about this later. I'm wondering if we're going to see us coast through the late spring and we're not going to see huge price jumps. Now, if you look at our still active percent for 14 days in the market, remember, lower is more competitive, but guess what? We are not as competitive as we were at last year at this standpoint. We definitely have more inventory out there in the market. And if you look at our list to close ratio, I mean, under a million, we're hovering right around 100%. We've jumped a bit on that marker for 1 to 2 million, but this is really not quite the same level of strength as we saw. And there's another graph here, days on market for new contracts. This one I think is really interesting, settling into kind of this 40-day period. Whereas if you looked last year, we're firmly in the 30 days. Does that mean we have tons of inventory and houses are just sitting on the market? No, 40 days is still a fairly tight market, but it's not nearly as tight as it was. And I think that's kind of the point that I want to make here. It almost seems like we had some pretty strong reduction in that, and we just kind of had this blip of a January, early February that was pretty crazy. Now, this is the chart that really is fascinating to me. Is if you look, I mean, that payment index, we got to extend this up again. That payment index has jumped. Rents have receded a little bit, but you know what's funny? I think we're going to see rents are permanently going to be at an elevated level. And this is a reflection of just a shortage of housing in general. But that payment index is now spreading to over, 1 unit back apart again. It's like our market has a happy place. So what does this mean for the future prediction of prices? Well, I think what this means for the future prediction of prices, right, is that, we've seen kind of some gains that happened early on in the year. And I just don't know if we're going to see that same level of gains later in the spring. I think we got some of our gains earlier on this year, which is incredibly unusual. Like, I don't think I can really remember a year in the past where that was the case. And so if you look at our prevailing mortgage rates, things have eased a little bit. As we're telling all of our clients, especially if you're in that high balance or jumbo category, we're telling everybody to at least take a look at those 7-year ARMs where they are fixed for 7 years. We're seeing some rates on those jumbo loans dipping back into the fives. So even though our prevailing 30-year fixed national rate might not be improving that much, there are definitely some opportunities in there based on that yield curve to get in at lower interest rates. This is just a very different world, I think, than we've seen. And I think to try to look and make a pattern out of some of this stuff and say, this is what happens in this part of the year, this is what happens in another part of the year, I think that's a mistake right now with the market that we're in. We have a lot of levers in the economy being pulled very hard right now. And it's difficult to see exactly what kind of effects, both short, medium, and also even the long term, we're going to see from that. And because of that, I think it's foolish to really talk about anything as being typical or expected. This is the kind of market, much like we saw at the beginning of the pandemic, where I think you really needed to pay attention as a buyer and seller to what's happening right now, right in front of you. This is not the market to sort of rely on old adages and past advice. I think that's really a lazy way to make the decisions. I think you actually have to put in that work and really make those decisions as you're looking at everything going forward and look at the data that's right out in front of you, not only the overall market data, which we show here, but also the individual market data. We're seeing huge differences between different market segments and different geographic areas, right? West Side LA might be hot 1 month whereas Northeast LA is cooling off, right? We're seeing a lot of differences between areas and pricing segments. A lot of that is because, lower segments tend to be more interest rate sensitive and upper segments tend to be more stock market sensitive. So, just a lot going on. You really have to pay attention if you want to be a buyer or a seller in this market. Obviously, if you'd like someone to help you do that, we would be happy to be your agents and help you do that. Don't forget to like, subscribe, and hit that notification bell. Questions and comments, as always, we love them, and we will see you again real soon.